at first I said, hey, I'm going to rent this out as much as possible. I just bought it, and it was a big investment, and I wanted to be able to recoup some of that investment. That was part of the plan. And a couple of things. One is, no matter how good your renters or property management company may be, when you're going up there to use it, I mean, my heart would like sink as I walked in every time, because it's our house, and then stuff's broken, things are missing. If it was just purely a business rental thing, it's fine. But it's like, geez, my kid is really missing that thing that he had here.
Welcome back to the show. I'm your host, Hale, and this is Point of Impact. Now, if you're looking for a perfectly passive investment, I'm afraid to tell you there just isn't one. But there is a spectrum when it comes to real estate investing, from active investing to more passive, if not completely. On the spectrum, active investing would be more like the wholesaling and flipping, which is more like a daily job, but you can turn that more passive by creating a business around it and hiring others to manage the labor part. On the other end of the spectrum, though, there are such things as REITs, real estate investment trusts, and private placements and alternative investments, alternative assets. And private placements are syndications. So today we've got Michael T. Parks, founder of the Navigating Wealth Fund, and he's going to explain why he went from managing a small ski rental to real estate investment trust rates, and now he's managing private placements, syndications, and is helping others to invest as passively as possible and enjoy all the benefits that come with real estate investing, like taxes, without having to deal with tenants and toilets and termites. Anyways, you're going to learn quite a bit here about the passive side of investing in real estate, the difference between a REIT and a private placement, and a whole bunch more. So, without further ado, Michael T. Parks. Michael, welcome to the Point of Impact. I'm glad to have you here.
Great. I'm happy to be here, and thanks for having me on. Appreciate it.
Well, of course, real estate, near and dear to my heart, and I've been part of a syndication or two and invest in single-family hospitality, and have done a little private, private money loans on both ends. So I love talking this stuff, and can't wait to get into it. Tell me, how did you get into real estate?
So I've always had an interest in real estate, and unfortunately, right after I graduated college, I was looking to get into a multifamily, do house hacking, which is now what it's called. It wasn't at the time. And my wife said, or my fiance, who was going to be my wife, said, "Are you crazy? I am not getting phone calls from tenants while you're out of town." And so my real estate career didn't take off very early. It actually started a lot later. She basically said, don't even try to leave me here with these tenants. So I went and bought a single family house. We lived in it. And about 10 years later, I started doing rentals for a ski house. So I bought a ski house. I'm in New England. And thought, like many people, you rent a ski house you buy a ski house, you rent it out, it pays for itself, and you get to go skiing up there whenever you want. Didn't exactly work out that way from an investment standpoint, but I certainly did some rentals, some vacation rentals. So the first investment I made in real estate is a ski house up in New England. And like many people, I thought, hey, this is a great idea. I'll buy a ski house, I'll rent it out, it'll pay for itself, and then I'll go ski whenever I want. And didn't exactly work out that way. I ended up doing a lot of skiing and a lot less renting. It didn't exactly pay for itself, and probably not the best investment, but I did enjoy that ski house. And that was my first, property rentals other than buying my own home. And then I went to work for some REITs, publicly traded real estate investment trusts. There was 30 billion in assets in the REITs. And that's really where I learned sort of the big business of real estate and started doing it more professionally as a job. And so, from there, I learned about real estate syndications. I bought a number of properties myself. I have 20 apartments in Western Massachusetts. I started investing as a limited partner in real estate syndications. I became a syndicator, and now I run a fund. So I help other people learn how to evaluate real estate opportunities, debt, equity, multifamily, self-storage, and as they want to follow this similar path and invest alongside me, they do so through my fund.
That's great. I'm curious first about the ski house in New England. What part of New England was it?
In New Hampshire.
Okay.
It's for anyone in the area that might know, Loon Mountain is the largest ski area in New Hampshire, and it's not the biggest by far in New England, but it's one of the bigger ones.
I used to be stationed in Newport and would make the drive up to say Killington and Snow, those areas, passing right through New Hampshire, hitting the package shop. but I'm curious because we do short-term rentals. Yeah, and we've got them in a few states now, but we live here in the Florida Panhandle, which there's a lot of seasonal traffic. So I'm curious about the mountain. Is it when you right sized your thoughts on short-term renting or ski renting? Was the seasonal thing your? I mean, what happened? Like, I know for me, it's. I love to use this rental for my own personal use, but I cringe every time I think of the opportunity cost and not taking a rental or taking a stay.
Yeah. So that's I would say that is similar to for me too, right? So at first I said, hey, I'm going to rent this out as much as possible. I just bought it, and it was a big investment, and I wanted to be able to recoup some of that investment. That was part of the plan. And couple of things. One is, no matter how good your renters or property management company may be, when you're going up there to use it, I mean, my heart would like sink as I walked in every time, because it's our house. And then stuff's broken, things are missing. And if it wasn't, if it was just purely a business rental thing, it's fine. But it's like, geez, my kid is really missing that thing that he had here, the stuffed animal or whatever, and it's gone, and those types of things. So it got to the point where we said, we're only going to rent it in the summer, which there is a summer seasonality up there. As fall too, with the people who go to watch the leaves, but the main rental season is the winter for skiing. And that's when we wanted to use it. So after several years, we decided, we're going to use it in the winter, all winter, and we'll rent it just in the summers. And certainly, the rental income was not enough to pay all the bills, but it certainly helped in some ways. But at least when we came there, we knew every weekend when we showed up, it was going to be the same as we left it. So that made it great. And we my kids grew up there skiing. We went there for 16 years before we ended up selling it. And about 10 years in, we stopped renting altogether. We said, it's really looking pretty run down, and we want to make it nice, and we just don't want it to get all beat up again once we renovate it. So we renovated it top to bottom. We used it for the remaining 6 or so years. And then we just sort of outgrew it and decided we didn't want to do that anymore. So we sold it. And now we do a lot of trips to warm weather down by places like you live.
The same, no matter where I would go. We started in Akron, Ohio, which is, I tell people, somebody saying, honey, before I die, I want to visit Akron, Ohio, is said by no one ever. man. But it's a great cash flow to appreciation place. And so it was a easier barrier for entry, a lower barrier for entry, and it's still the best return on cash we've ever made. And we're still adding to those. But here in Florida, it's of course you're closer to the coastline you get, it's like exponentially more expensive by the foot how close you get to water. But what I wanted to ask is, you then you started you started in REITs, real estate investment trusts. Can you explain for the audience, maybe expand on what a REIT is and how you went about finding assets for and managing these?
Yes, for sure. So I'll start with what a REIT is. A REIT, a real estate investment trust, is a specific legal structure which is used to purchase and hold real estate, and you essentially buy ownership into the trusts, into the units. And for us, these REITs were publicly traded. There are such a thing as a private REIT, although I don't know too many people that use that structure anymore privately. There's other structures that are much more popular. However, publicly traded REITs are very common, and so that means they're traded on the stock market, and you trade them like a stock, like Amazon stock, or even more like a mutual fund, because it's sort of a collection of assets. So the nice thing about REITs as an investor is it's liquid. You can buy and sell it anytime you want when the stock market's open, and so you're very liquid. And it's a good way. And then, every REIT has an investment thesis. So some of the REITs that we worked on, one was focused on hotels, one was focused on logistics properties, one was focused on what was called single income properties. So basically an entire property that had one tenant in it, which can have some efficiencies to it. So, and there's a lot. And then one was senior living, so senior living facilities. So one of the nice things about REITs is everyone has an investment thesis, and as an investor, you get to sort of choose the investment thesis that you want to put your real estate portfolio into, and you can invest in REITs that support that. So that's how kind of REITs work. I would say kind of downside of REITs as an investor is that they too tend to have a couple of things. One is a fair amount of overhead on them, so expenses that are taken out before your returns. A lot of the REITs will not do a lot of additional services that create value for you as the REIT owner, or a shareholder in the REIT, because by the REIT structure, it has to be a holding of real estate. And so let's say if you wanted to implement like a co-working space within a building, that's an operational business. And so that's not exactly, once you do too much of that stuff, you sort of get yourself out of the rules of a REIT. And so you don't get as much maybe creativity in terms of how to drive value on properties sometimes.
Mm-hmm.
So there's, pros and cons, and ultimately returns on REITs tend to be lower than private placements. I'm sure we're going to get to talk about private placements with syndications. Returns on REITs tend to be lower, but you do have that liquidity. And then for me, I've been a technology guy. So when I went to the REITs, I actually ran a big chunk of the technology department there. So I wasn't picking and choosing properties myself, but I certainly learned about how we do all that. And it's really no different for REITs than it is for anybody who's, into, let's say, a syndicator. You're looking for properties that meet a certain criteria, right? So whatever your properties are, and if you're focused in the Panhandle of Florida, you're looking for a certain number of units. If it's a multifamily apartment building, you're looking for certain cash flows. All of your criteria. The REITs have the exact same thing. But the difference is in the publicly traded REITs, at least the ones that I was in, we were often looking for what we called class A assets or just commercial grade assets. So they tended to be larger. They were stabilized. A lot of people would consider them lower risk because they had, a fair track record in terms of stability in the buildings with occupancy and so forth. But I actually look at that as a little bit of, in some ways, it's a little more risky, even though traditionally it's looked at as less risky. But in any case, they have criteria. They get them through brokers. A lot of syndicators make a living of finding a poorly performing building and making it perform better through either renovations or just better management, and then selling it to a REIT. A REIT tends to often be the final destination for a building. When all the value's been added and the thing's really solid, that's when the people who are going to pay the most for them typically are REITs.
Do they, these REITs, like the trust managers, do they let these things go from time to time? Can you buy them from REITs?
Sure. I mean, they do. At least the REITs I worked for are more in the business of buy and hold and expand. And if you think about, the people that are involved in the company that runs the REIT, those people want to, grow their company's profits. Their companies make profit based on the dollars that they have under management, the assets under management, the AUM. So to sell a building frees up a bunch of cash. They want to go put that to work in another building. And some of that happens, and some REITs probably do more of it than others. But the REITs I was part of, largely it was about acquiring portfolios of assets and getting more investor money in to continue to grow the size of the REITs.
Well, I don't want to spend too much time on this because I definitely also want to get into the private placements. But why are REITs so attractive to some investors? I know it's like a mutual fund, but it's like a dividend fund because they're required REITs are required to pay out a certain percentage of the cash flow. And what are some of the drawbacks to it?
Yeah, I would say the drawbacks are that the overall returns are not that great generally, right? Mm-hmm. And so, the good news is there is cash payouts that if people are looking for income, that is one way to look to get sort of steady income. When you look at that compared to where what you could do in the money market or things like that a couple of years ago, it might have looked attractive. I would say where rates are now, it probably looks a little less attractive. So the downside is I think the overall returns are not that stellar. The upside is that it is very liquid and it's a way to put your money into real estate really without having to do much work. It's like picking a mutual fund of real estate.
It's easy, man. It's very low maintenance for the investor because you're essentially buying a security off the internet or from your broker, and it's real estate, which makes it safe. But safe, diversification in a mutual fund or a REIT also kind of diversifies or mitigates your profit potential or success. It's a slow growth type of vehicle because it's, for one, cash flow. A lot of those profits go out to the investors. Anyways, you started into private placements, and tell me about Navigating Wealth Fund and how that came about.
Yeah, so I got into private placements really just through learning on a lot of podcasts and local meetups. And so I had bought 20 apartments on my own in Western Mass. And I said, I'm going to at some point, I just got all my money tied up in these apartments, and that's great. And I was like, I would like to have my money go further, right? And so with private placements, which is one way to think about a private placement as a syndication, I started investing in some of my money there, learned about syndications, and then actually built a team. So got together with some experienced syndicators, general partners, and worked with them to identify some properties, and we went ahead and started syndicating. So that's how I got into the syndication business. And the next step, the next evolution of that many people in that position are doing is taking it to a fund level. So instead of raising money and investing in just one asset, which is be like a syndication, is usually one asset, might be a couple predefined assets. In the fund, you can raise money for many assets. And so with my partner, Jeremy Lemire, we launched the Navigator Wealth Fund this earlier this year. And in our fund, we can put a lot of different kinds of deals. We can put in your traditional equity investment on an apartment building. We certainly will do some of those things, whether that's a value add apartment building. Well, we're working on a build to rent portfolio. One of our other partners, we are going to be building a series of duplexes in Michigan, and we'll be putting that through the wealth fund. We're also going to do some lending. So we've done some lending already. With the way the market has gone for interest rates and with banks, there's a great opportunity right now to get very good returns, call it 10, 12, 14% on a loan. And that loan is in a much better risk position, meaning less risky than an equity position. And there's a lot of great opportunities in the market like that right now that we like. So we're bringing those loans into our fund as well. And the interesting thing about our fund, different than a lot of funds, is that the investor gets to choose which investment they want to allocate their dollars into. It's called a customizable fund. And so, a lot of times in a fund, like a mutual fund, you sort of get the average of everything going on in that fund. With our fund, when an investor invests, it's really a little more like a syndication in that they say, I would like my, $50,000 to this investment and another $50,000 to this loan. And then this other investment over here, that's maybe one of your self-storage ones. I don't want to be involved with that one right now for whatever reason. And that's okay. At the end of the year, they get 1K1 from the fund. They got one fund manager, which is, me and my partner, Jeremy, and one set of updates. So it simplifies the whole process for them, but still gives them the control of deciding the exact assets that they want to invest in.
So instead of saying, like any most funds, you invest in the fund, but you have no choice in what the fund manager, buys, invests in. This customizable fund, the investor actually has a little bit more determination on what assets are being invested in or where their money goes.
That's right. Yeah, I mean that's exactly right. They don't just have more choice; they have all the choice. The options are there in the fund, and then they get to choose which ones they want to be invested in, and then their returns are specific to where they've invested their money. And so if, those do particularly well and maybe one that they didn't invest in doesn't do as well, it doesn't affect their returns.
Are these, first, who's investing in your funds? And are they all, are they sophisticated? Are they accredited investors? And kind of a, section of the market are you tailoring to?
Yeah, we are all accredited investor only, right? So that's why I'm able to come out here and tell you all about it. In the future, we hope to have offerings for non-accredited, sophisticated investors that we have prior relationships with, and we do have people that get to know us, but we don't have an offering right now for non-accredited investors. So we are accredited, and then in terms of who it is. A lot of them are people that it's interesting. So people that I know, people that I've worked with over my many years in business in New England. A lot of them tend to be, people have moved up the corporate ladder, have been saving, done fairly well, and they're just taking a look at their portfolios and saying, I got everything in the stock market. And as well as that's done at times, and continues to do, it's like, how can I retire on that? And so they're really focused on, how do I turn my savings into a reliable income that I can feel comfortable retiring on? And so a lot of these investors will take portions of their portfolio. And sometimes it's even portions of their portfolio in their retirement accounts, like their 401ks or IRAs. And they'll say, I want to allocate this toward real estate instead of the Wall Street products. I want to put it in, seek better returns. And sometimes they're still seeking really good returns. So they'll put it in deals that are equity based for maybe, say, a development project, right? A development project, like a ground up development, generally perceived to have higher risk, and therefore the return potential on it is higher. They can be 20% plus on a development deal. Others say, okay, that's interesting. I don't know that I really want to get into that. I'd rather see something that's more of a value add apartment building, where go in, you already got tenants, you're going to renovate units as they change over, raise the value of the building and get me some good returns in a 3 to 5 year type of a time frame. And then there's others who say, I just want income. I want income every month. And so for them, a lot of times that's our lending products, because lending products tend to produce income on a regular basis. And, because of where we're positioning our lending in the marketplace, we're doing deals that aren't easy to get loans against from a bank, because a bank might lend it at, today, 6.5%. It depends on the area of the country you're in. We're lending on projects where the banks aren't so willing to go because it doesn't fit their criteria. And so we can get, 10, 12, 14% on loans for our investors.
Are there other advantages, say, like tax advantages, if they're not investing in, say, an IRA, or are there other advantages to investing in real estate funds versus stock market?
Oh, well, for sure. So, when you invest in a real estate private placement, you are an owner of the property. You're a partial owner in the property. And so when you're a partial owner, you get a portion of what's called depreciation. I know much of your audience knows this. The depreciation is basically the paper losses, the value of the building that is supposedly decreasing because it's being, got wear and tear. However, the reality is we know properties tend to go up, not down in value. So those paper losses and then some other techniques like cost segregation, accelerated depreciation, some things that are in play right now allow you to take a lot of that up front and create some passive losses for your tax returns. So all of that's true in a syndication, as it is in, if you just owned a property. It's also true in a fund like ours. But when you get into, Wall Street type products, you're not going to get that. So this is, that's certainly an advantage. And then, just because you brought up taxes, Aaron, in an IRA, one of the things that, people don't realize sometimes is if you invest with your IRA money into an equity in a, let's say in a real estate, an apartment, and there's a loan on that apartment, and there's almost always a loan with real estate, right? Rarely do you own a real estate outright. So when there is a loan and you've bought in with your IRA and it makes money, your IRA has to pay some taxes. It's called UBIT, unrelated business income tax. And basically, without getting into the details, I'm not a lawyer or a CPA. Basically, your IRA is making money off of the loaned money, not just the IRA's money. And because of that, your IRA pays taxes. And somebody's going to say, that's crazy. What? It's an IRA. How can it pay like that? The point of an IRA is not to pay taxes. But in this case, you have to. So what a lot of our investors that have IRAs like to do is invest in the loan products in our portfolio instead of the equity products. because there is no you bet. You are making a loan, you are getting interest for the loan, and there is no unrelated business to tax. That is the business.
Interesting. Uh, what kind of assets are you investing in? Besides, I would like to explore the loan products, but you said it's an alternative asset fund. Can you define that a little bit for us, and um, what you're looking for? What's your appetite right now?
Sure. Yeah. So when we talk about alternates, I put all this real estate private placement stuff. It's all in the world of what Wall Street would call alternates. And there's other stuff in there: gold, silver, metals, oil. And I don't play in any of those in terms of, like, that's not my business. So I really can't speak to those portions. But the alts that we do deal with is real estate related. And as far as, within real estate, it's a pretty broad area, right? So like at the REITs, I talked about a number of different types of real estate that we invested there. Our fund is focused on multifamily, which is apartment buildings, also self-storage units. My partner Jeremy runs most of the large self-storage units in the greater Green Bay, Wisconsin area, and we are going to do build to rent, so ground up development, build to rent, single family duplexes, type of stuff. So our MO on that is to build highly economically, and we build with very green techniques that keep operating costs low through really smart design. We've got a partner that's really an expert in this area, Dr. Lee Newton, if anyone wants to look him up. And so we are working on a build to rent project with him right now. So we do debt and equity on all of those.
So are you also doing the asset management and development, or is this
Yes.
partnerships?
Yeah. So the build to rent, we will do it in partnership with Lee, Dr. Lee, and we will develop it. He's a developer. And Jeremy and I have also done development. We've done some hotel conversions. We haven't. I don't. I don't believe I haven't done ground up development. I believe Jeremy has done some. So, but yeah, we develop it and then we operate it. We do turn it over to third party property management once it's stabilized and rented. But there's not a lot of property managers that like to get involved when you're doing development or heavy construction, which is, at least in that's the case in these scenarios.
Uh-huh. And when you're talking about loan products, are you buying off the secondary market, or are you originating with hard money loans, private money loans, that kind of thing?
Yeah, originating loans, basically fix and flip loans is part of it. Also, mezz debt. So for people who aren't familiar, mezz debt or mezzanine debt is basically when you take out a loan on a property, it creates a lien. The person who gave you the money creates a lien on the property, and that lien is in first position, typically if it's a bank or agency debt like Fannie or Freddie. And then sometimes you need to put a loan in underneath it in a second position. And when you do that, it's called mezzanine debt. So we do like mezzanine debt. The reason is it's got a much higher interest rate because it is in a second position. And if you do good analysis, good underwriting, you can still be in a very safe position, but get a much better interest rate. And then sometimes it's, we call it senior stretch, or you do both first and second position, so that you're in control across the board, but you've got kind of two different loans, going on. So we like the higher interest rate loans, and you can do that in these types of fix and flips and development or mezzanine positions, things like that.
And if you wouldn't mind going a little bit deeper on this, how are these more attractive than the other assets in your fund?
Well, so for us, it's around what's our investor looking for? And so an investor that's looking for steady income at a fairly high rate of return in a pretty low risk position, like not much chance of losing it, that's where loans are, we think are a good place to be, and where we would, we find our investors who want that. They want to be in the loans. Other investors, maybe it tends to be sometimes just, I wouldn't even say younger, but people who feel like they've got more years ahead of them and want to take bigger risks and bigger swings. They tend to look at some of these loans and say, geez, 10%, that's not, I get better options, in 15 or 20% doing development and some other things. And that's fine. And so we do have those in our portfolio too. They do tend to carry higher risk, and they usually that payout gets more back end loaded. The loans get paid out every month. Equity, you might get some payments every month, right? Sometimes you got to kind of get the building to a place where it can make money, and then you start getting some distributions, but you don't really get those bigger returns until you're selling the building at some higher price point later. So to me, it's what is the investor looking for? Loans are great for steady income and lower risk, and development and value add apartments and hotel conversions. That's bigger risk, potentially bigger reward, usually loaded toward the back end of the deal.
I'm sorry. I don't know if I caught it, missed it. Are you originating these loans, these secondary market purchases?
We're originating them.
Okay.
Yeah.
And when you're originating, you said 10% loans or in that range after management. What kind of return is that after the expenses for the investor?
Yeah, we look to get our investors 10+%.
Oh. And how's that compare, generally to the other asset classes in comparison?
Well, so that the way I guess, look, every deal is different, and every result could be different. But generally speaking, the deals I see and the deals that we bring in, if you look at it from what is an investor going to get out of it, loans roughly around 10%. You talk about value add apartment buildings, you're more like 14, 15, 16%. And then development more like 18, 20, 22%. And that's just, where I see the market right now and the types of deals that are out there. And I would say that if you're seeing deals that look more aggressive than that, it's certainly a flag to take a look at what's driving those numbers. I think, as you know, anybody can make a deal look great on paper. It's can it be executed? Can it be delivered? How much risk is in it, right? I mean, you could take any apartment building, for instance, and decide that the rents are going to go up, 10% a year for the next 5 years, and have it look absolutely fantastic on paper. But if that's not a realistic scenario, which it probably isn't, then what the return that's projected doesn't mean anything. So certainly, I wonder, do you see that, Aaron, where you are in Florida? I know Florida's had a lot of rent increases recently. Do you see deals out there where there's people are saying, hey, rents have gone up by 8 or 15% or whatever the last few years, it's going to keep going?
Oh, yeah. Well, this is a high appreciation area along the coastline. Of course, Florida is, the only state where the further north you get, the more southern you find yourself. But as far as appreciation goes in rents and all that, you've got to also take into consideration that insurance rates have gone up 50, sometimes 100%. So it's taken a huge chunk in many out of our returns, And sometimes it's completely eliminated the cash return. Now, on the other side, the flip side of that is the equity, the appreciation, which even in a down market, Florida's appreciation, at least in the last few decades, has only slowed and not really back. It hasn't really depreciated. So, it's what you're looking for, just like your various assets in your funds. Whether you're looking for more cash flow or equity appreciation. What I was going to ask about the loan products is how that the economy affects the returns in the fund. So if you're taking into consideration inflation, I know that's great for the investor because it shrinks the size of your mortgage. But how is that good or bad for your investors who are then the bank? And then, of course, appreciation of assets or appreciation of the notes. How's that work?
Yeah, so with loan products specifically, right? That there's a value, a value to the note. If the note is at 10% for 9 months or whatever it is, there's a value to it. And as long as it's performing, meaning it's being paid, the economy might value that note, or the market might value that note more highly if the market rates go down. So if you have a note that's paying 10% and market rates are 8%, then it's not that much higher. But if the market rates are down at 3%, you're going to go put your money in a CD. It's that 3%. Well, 10% looks really, really good. So I would say to some degree it changes the value of the note. For us in our fund, we hold our notes through termination. So we hold them until they're paid off with all the interest. So we don't pay a lot of attention to the secondary note market where you could buy or sell them. And you did ask me if I was doing that earlier. It's certainly something that I want to start looking into, is purchasing notes, particularly non-performing notes. So in a non-performing note, it's not being paid, right? And if it's not being paid, it's not nearly as valuable as if it's being paid, because your chances of collecting on it are either that much lower or that much harder to do it. So I do think that something we'll be looking at putting in our portfolio for our investors is non-performing notes, where we can purchase them and then get them to perform. Basically, take the actions necessary to either renegotiate those notes to a favorable terms that the borrower can now pay, or potentially take the property that backs them and go through the process that way. But that's always a last resort. Usually, people who are doing non-performing notes, if they are good at it, they don't often have to take the property. They find a way to make everybody happy, including their investors. So in the future, that's part of what we'll do.
I imagine they're a little bit more hands-on. They're trying to help that note become more perform better. Essentially, have the borrower find a way to renegotiate and get the borrower to start paying. But I would imagine after quite a few years of steady appreciation, free money, and people buying a little bit more house than maybe they should have, and the economy slowing down as it has, imagine that non-performing notes might be there might be more of them in the market to invest in. So for you, what's next? What's on the horizon, and what are you excited about now?
Business wise, I'm excited about this build to rent portfolio that we're working on. And then we are going to have another fairly sizable mezz debt opportunity coming up. on a hotel conversion that should have some good returns on it. So I think, we don't do a ton of deals. We really do a lot of due diligence to make sure that the deals we're doing, we feel very good about. And because of that, a few a year, that's what we shoot for. And we want to make sure that we deliver or over deliver our promises. So
That sounds great. I've got quite a few associates, friends, acquaintances that are doing the boutique hotel market, and that's the next evolution or next step beyond the Airbnb and single family short-term rental is just like long-term rentals. Maybe you cut your teeth on a couple small residential units, and many graduate up to the multi-unit. Same with short-term. But trying to think of, is there anything that I've missed that you'd like to share, or anything that I haven't asked that I should have?
No, I think we covered a lot of ground today for sure. I would just, welcome anyone in your audience that if they'd love to reach out to me. I'm glad to talk people through how I see the market, different opportunities out there. And that's what I do, is I help people understand this world and help guide them toward whatever is going to make them successful. So ultimately they can retire confidently. And that's kind of our approach.
Excellent. Well, that will lead into the final segment of the episode. That's the countdown to impact. That's 3, 2, 1. 3 books, 2 quotes, and 1 person that have had an impact in your life.
Okay. So books. One I read early on that has always stayed with me is the Covey 7 Habits of Highly Effective People. And, I think what's great about that is it really is just around the core of how you operate with integrity and your ability to get along in any situation. So I've read that a couple of times. It's been a while, but I have read it a few times, and I think that it has a lot of great teachings in it that are time tested.
It's definitely a classic.
Yeah, for sure. I love the 80-20 principle. I think there's so much truth to that in terms of being able to get more done with less time by focusing on the right things. And then the last one I'll call out is Chris Voss's Never Split the Difference. That book still just amazes me. Like the teachings of negotiation from the way Chris Voss approaches it is it's actually changed my whole mindset around negotiations, and it's a lot more enjoyable now. So we do a lot of negotiating in the real estate world, so that's a good one.
Yeah, I love that book. I mean, just even the anecdotes, the stories that go along with the lessons are pretty great, but the lessons themselves, more empathetic, approach to negotiation.
Yeah. Couple quotes. All right. So one of them, and I don't know who to attribute it to, but it seems to come up all the time in real estate development. It's, if you're saying you cost less, why did you charge me more? And I don't know if that makes sense, but it seems that every time we get into negotiations with contractors, they always say how inexpensive they are, and they're talking about hourly rates and things. But yet at the end of the day, the bill is higher. So how could you cost less and charge me more? And then I guess the second quote would be one I learned from a leader at Accenture. I worked at Accenture for many years. It's a large business consulting and technology company. And one of the leaders there said, you have to know the way, you have to show the way, and then you have to go the way. And I've always kept that close to how I operate, right? You got to know where you're going. You got to show people where to go, and you got to go there yourself. You got to do it. You can't just tell people what to do. You got to be out there leading. So I like that quote a lot.
I like that. Yeah, in regards to your first quote, yeah, your contractor getting a discount doesn't necessarily mean you get a discount. I mean,
Right,
that's great.
right.
How about one person that has had an impact in your life?
You know, I'm going to say my dad, and I'm going to say my dad for probably for many reasons and more than your audience will want to know. But my dad worked extremely hard, as many people do, and he went out on his own and he bought a machine shop, a company that makes machined parts, metal parts.
Hmm.
And for the better part of my middle school, high school career, I heard about business and the machine shop and, suppliers and customers and all these things going on in the business every night at the dinner table. And I didn't really think much of it until I kind of got into the workforce and got into business and got into technology. And I just realized how much I knew about how all that stuff worked from learning from his experiences and his challenges every day, running and operating this business. So, from a business perspective, my dad taught me way more through all of those dinners, I think, than I probably learned in college, and of course, there's a lot of other reasons too from a personal perspective. But I would put my dad's number one.
I tell you what, the so-called blue collar uh, business owners, or blue collar folks in general, have gotten such a bad rep through the whole last generation. We've just put a stigma on that, but some of these people, I just had John Wallenberger, the CEO of Owl Vans, on, and he went from white collar family, Silicon Valley, to and halfway through Berkeley to, as he said, coming out blue collar, and as though it was coming out of the closet. Uh, but he started a company doing quality fabrication, and now that thing's they're selling tens of millions of dollars worth of aftermarket equipment uh, to the Sprinter van community. It's incredible. And you know what? Who was it? Mike Rowe and Dirty Jobs. He said most of the people he had on his show, you know, coming home sweaty, dirty, stinking to high heck, and also smiling and millionaires. But gotta appreciate your dad for what he taught you. That's great. Well, Matt, uh, did we get your links? Let's share how somebody can get in contact with you.
Sure. Best way to find me is on our website, navwf.com. So it stands for Navigator Wealth Fund, navwf.com. You can book a call with me there. You can also email me, michael@navwf.com. Those are the easiest ways to get me, and love chatting about real estate and investing and all those sort of things.
Awesome. I noticed that in your email address, so I looked it up, and I was thinking, because I used to be Navy, and we shortened the acronyms, the titles of certain commands, NAV, Nav, School, SCHOL, EOD, Explosive Ordnance Disposal, was the school I instructed at for EOD. So anytime I see NAV, I'm thinking it's a command in the military. And I was, what is WF? Oh, wait a second. I know what he's doing. But okay, we'll get those links in the show notes. And Matt, I really appreciate your time today, sharing about navigating Wealth Fund and your expertise. Thank you very much.
Oh, thanks for having me on, Aaron. I appreciate it.